In this video, we're going to be looking at technical analysis for beginner traders. So I'm going to be telling you what technical analysis is, how it's different from fundamental analysis, which one of those two I think you should be focusing on. Then I'm going to tell you the key principles of technical analysis for beginner traders. So technical analysis covers any analysis which is done on the chart, so it actually covers a really broad spectrum. It covers things like candlestick patterns, chart patterns, volume, indicators, trading tools, price action, and also a lot more. Another type of analysis is called fundamental analysis. We're not actually going to be looking at that in this video, but just to let you know, fundamental analysis covers things like news releases, economic data, politics, etc. So which one of these do I think that we should be focusing on? I actually really believe that traders need to look at both. A lot of traders think that they can pick one, but actually I think looking at both can give you a real edge, because fundamental analysis will give you the reason why the market is moving in a certain way. So the market doesn't move up because of a candlestick pattern, it moves up because the economy is doing well. So the fundamental analysis gives you the reason why, but the technical analysis side will help you to make sense of that on the chart so that you can plan your entries, your exits, and also your risk management. So in the next video, we're actually going to be covering fundamental analysis. So what I would suggest is that you subscribe to Thinkmarkets now so you don't forget. And also if you hit the bell button, you'll be notified when that video is released so that you won't miss it. But for now, we're going to head over to Thinkmarkets and I'm going to show you the key principles of technical analysis for beginner traders. The first thing that we're going to look at is chart types. So you may have seen candlestick charts before. Candlesticks are a visual representation of how the price has moved over a certain period of time. The green candlesticks show us when the price has closed higher than it opened, and the red candlesticks show us when the price has closed lower than it opened. You can also see there's a thin part and a thick part. The thick part is called the body and the thin part is called the wick. The thick part shows us the open and the close, and the thin part shows us the extreme. Generally, the more wick that there is on a candlestick, the less certain the market is looking, and the more body, the more certain. There are many other different chart types as well. You can see traders sometimes use line charts. This can help to eliminate some of the noise so that they're not seeing all of the detail, but they're just getting a rough idea of where the market is going. Another type which is very popular is Heikin Ashi. Heikin Ashi can gauge momentum. You can see that these look similar to normal candlesticks, but also slightly different. These ones start halfway up. That's because they're not showing us the exact open and close. They're actually showing us an average, and therefore this can become really useful for helping us to gauge momentum. We're now going to look at time frames. At the moment, we're on the 1 minute chart. This means that each one of these candlesticks, I'm going to switch back to normal candlesticks for this, each one of these candlesticks shows us 1 minute in time. So each one of these candlesticks shows us the journey the price has been on in that 1 minute. But we can use any time frame we want. We can use the 2 minute, and now each one of these candlesticks shows us the journey that that price has been on in a 2 minute period. But we can go higher. We can go to 5, we can go to 30, we can go right up to a day or even a month. Now this is really giving us a really big picture idea. What time frame you use is going to be dependent on what type of trader you are. If you're trading on small time frames, such as the 1 minute, the 5 minute, the 15 minute, you're more of a scalp trader. This is more for when you're looking for small movements in a short period of time. If you're a day trader, you might be looking at the day chart or the 15 minute or maybe the 4 hour. And if you're a position trader, if you're holding your trades for a really long time, you might be looking at the 1 month or the 1 week or the 1 day. Traders also like to use indicators to help them make decisions. There are thousands of indicators. And when you first start trading, it can be tempting to put too many indicators on your chart or to think that there's going to be a holy grail indicator. But the truth is, a lot of the indicators use past data, and therefore it's not so much about finding the perfect one, it's more about using a handful of them to help you make decisions and to understand how those ones work really well. So a couple examples. Average true range is a popular indicator. The average true range at the moment, you can see down here, it's on default setting 14. That means that it's showing you the average price that the market has moved over 14 candlesticks. We're on the 1 month chart. So this is showing you the average that the price has moved over 14 months. So it will take the last 14 months, it will add them all together, and then it will divide it by 14. And you can see this is the number that you get here. And can you see as I move my cursor over the different candlesticks, the number is changing. That's because it's adding the previous 14 candles. You can use this on any time frame. You can use it on the 1 day, for example. And now you can see that the number is a lot smaller because it's now taking into account the last 14 days rather than the last 14 months. This is quite a useful indicator because if you understand how much the market typically moves, you've got an idea of how much it's likely to move, and therefore it can help you with things like your take profit. I'm just going to close that down for now and show you another tool which traders like to use is the Fibonacci retracement. So for example, you might drag it in a downtrend from the swing high to the swing low. And can you see how we've only gone from this point here to this point here? So from this point on, traders would look at these levels to help them make decisions about where to place their orders. And you can see that sometimes it does work quite nicely. Sometimes you do get sharp reversals off these levels, a really nice one there as well. It's believed that it works because so many traders use it that it becomes a self-fulfilling prophecy. And I'm going to take that down and we're going to look at some of the trading tools that you can also use. So Trendlines is also quite a popular one. For example, a trader might draw on a trend line. A typical way of drawing on a trend line is to say that it needs to touch at least 3 points to be valid. And then when it breaks, you might start to look for buy positions, or if it rejects the trend line, you might start to look for sell positions. As well as trend lines, you also have lines that go horizontal straight across. So traders will often mark up the all-time high and also the swing lows. And these become support and resistance levels. So the market will be above a support level and it will be below a resistance level. Often these become points where traders are looking to put their orders. Sometimes they'll expect it to break above, or sometimes they'll expect it to bounce off. So exactly what you do with these levels will depend on your trading strategy, but they're a very popular technical analysis concept that a lot of traders use. And one of the most important elements of technical analysis is risk management. So on Thinkmarkets, you can use your long position and short position tool. Let's say we're going into a buy position. We want to plot the long position tool on here. You want to be able to manage your risk appropriately. So you want to be able to see, do you have a good risk to reward? Here you can see the risk to reward ratio on a position tool. In this instance is 6.2. However, this was just a random example. This is not a trade that I'm going to take. It was just showing you how to use the tool. But having a good risk to reward ratio can give you an advantage. And using the long position and short position tool can really help you to see your trade mapped out on the chart and give you an idea if it's realistic and if it does have a good risk to reward ratio. So now you understand the basics of technical analysis for beginner traders. The next video we're going to be looking at fundamental analysis, so if you don't want to miss that video, make sure you hit subscribe to Thinkmarkets now, and if you found this video helpful, then make sure you give it a little thumbs up.